All right, let's look at the data. They're all over your feed, right? TikTok, YouTube, Instagram, promising you alpha, the inside track to financial freedom. But what does the performance data actually say about their advice? Well, the numbers reveal a critical divergence that every single retail investor needs to understand. So, let's dig in.
First things first, let's establish our terms of reference. We're using the official definition from IOSCO. That's the International Organization of Securities Commissions, basically the global standard setter for regulators. They define a finfluencer as anyone using social media to share investment-related content. And we're not just talking about hot stock picks here. This covers the entire digital ecosystem of financial info.
So here's how we're going to break this down. First, we'll look at the rise of the finfluencer. Then, we'll get into a major red flag in the data. After that, we'll cover the global regulatory crackdown that's happening right now. And finally, we'll talk about how you can navigate all this noise.
So how in the world did finfluencers become such a dominant force? Well, their growth wasn't random at all. It was a really strategic response to a clear gap in the market aimed squarely at a new generation of retail investors.
So what's really driving this explosion? It's a pretty powerful mix of factors. For one, they're amazing at breaking down really complex financial topics into content you can actually digest. They also use personal stories to build trust and seem relatable, which, let's be honest, is something traditional finance firms really struggle with. And critically, they build communities. They're meeting new investors right where they are on their favorite platforms.
And their strategy is smart. It's a multi-platform approach to get their message out everywhere. YouTube is where they do the detailed, long-form analysis. Instagram is for the quick, bite-sized visual stuff, and they use Facebook to build those communities through dedicated groups and live chats.
Okay, so what exactly are they pushing? The content is broad, sure, but the regulatory data shows a huge concentration in one area. A full 64% of their content is focused on individual stock recommendations. Now, from a risk management perspective, that's a huge deal because single stock exposure is where retail investors face the most risk and the biggest potential for getting bad advice.
So what you've got is accessibility, community, and a heavy, heavy focus on high-risk single stocks. This whole combination leads us to the most important question of this entire investigation.
Yep, that is the multi-million-dollar question, isn't it? To find out, regulators started digging into the actual performance data behind all the hype, and what they found is a critical market anomaly, a massive divergence that every retail investor really needs to see.
The IOSCO report, it cites this one study with a truly staggering conclusion. 56% of finfluencers were classified as anti-skilled. Let's be really precise about that term. It means their investment picks generated negative alpha. Following their advice would have literally led to capital destruction compared to just holding a simple index fund.
Now this is where it gets really interesting. The data shows this crazy paradox. The finfluencers with the worst performance, the ones who are demonstrably anti-skilled, they often have the most followers, the highest engagement, and the biggest influence. It's a complete inversion. Skill and influence are actually negatively correlated here.
And this documented underperformance is exactly what's driving this global regulatory focus on the key risks. The number one concern? Unlicensed people giving what amounts to investment advice. Then you've got them promoting unsuitable products, making misleading claims, not disclosing their conflicts of interest, and in the worst cases, running outright fraud schemes.
Okay, so a systemic risk this big was bound to have real-world consequences. Regulators are officially shifting from just watching to taking active enforcement measures.
And this isn't just a warning shot. Enforcement is happening right now, all over the world. In Australia, a finfluencer got hit with a permanent injunction. Over in France, they're leveling monetary sanctions for market manipulation. India is issuing orders against unregistered advisors. And here in the US, the SEC has been busy handing out cease and desist orders and big penalties, especially for illegally promoting crypto. This is a coordinated, global crackdown.
And it's not just the influencers getting hit. Regulators are now going after the brokerage firms that hire them for marketing. A perfect example is FINRA fining M1 Finance for $850,000, specifically calling out the failures in their social media program.
But it's not all just about punishment. Regulators are getting pretty creative, actually, fighting fire with fire. France's market authority launched a campaign called Investipolis. They used an anime style on TikTok and Instagram to teach young investors about risks and scams, meeting them right on their own turf with content that actually connects.
So with this landscape of information and a lot of misinformation, the critical question for you, the retail investor, is, what is the best strategy to protect your capital?
So, IOSCO, the global regulatory body, boils their advice down to 4 essential steps. 1. Check their credentials. Are they actually licensed to give you advice? 2. Be skeptical. Extremely skeptical, especially of anyone promising guaranteed high returns. 3. If you don't understand the product, just don't invest in it. And 4. Always look for the conflict of interest. Are they getting paid to tell you this?
So looking forward, the regulatory focus is really twofold. First, it's on the Finfluencers themselves, pushing them to make sure their content is accurate, objective, and totally transparent about any conflicts. And second, it's on the social media platforms. Regulators are demanding they do more to flag, demote, or just remove harmful content before it goes viral.
And all of this brings us to the final critical question. As regulators, platforms, and influencers all adapt to this new world, who do you think is ultimately responsible for protecting your capital? That's a question every modern investor really has to answer for themselves.
And as always, please remember, this analysis is purely for educational purposes. It's based on data that changes incredibly fast. You have to do your own due diligence before making any investment decisions.
We are tracking these flows in real time. While you analyze the next move, check out the tools in the description. Sign up for Public to get $20 in free assets, check Webull for that BTC promo, or look into NVDA on Moomoo. Links are down below. Like and subscribe for more deep dive analysis. Stay disciplined, stay liquid.